What we would like to do now is we would like to go through this paper. Again, the paper is entitled Industry Momentum Strategies and co-authored with James Kolari from Texas A&M University. Let's go first through the abstract. So then we get already a good clue of what the paper is all about. So in this article, we investigate industrial momentum strategies. Our finding indicates that industry portfolios that outperformed in the previous months generate, on average, significantly higher returns in the holding period than those that underperformed. Plain and risk-managed strategies or volatility-managed strategies using the short-run industry momentum are not subject to optionality effects. Also, the tail risk of these strategies are uncorrelated with traditional industry momentum strategies. The spread associated with the risk-managed strategy both meets necessary conditions as a risk factor and is significantly priced in the cross-section of US industrial portfolios. So the motivation or the major idea or key aspect of this paper is that standard pharma and French risk factors turn out to be, they do not explain the cross-section of industrial returns. So, of course, the question arises, which risk factors then span the returns of industrial portfolios? So this is the first paper, at least as far as we are concerned, that addresses this question. So it was already an earlier paper from Levelle and Nankel and Scharen that basically explored the usefulness of the standard pharma and French risk factors such as size and value for pricing industrial portfolios, and they came to the same conclusion. So they basically argued that adding in industry portfolios to the cross-section of stock portfolios, equity portfolios, it turns out to be that the standard pharma and French risk factors do not add much to explaining the cross-section of industrial portfolios. So filling this gap in the literature, our paper here explores the asset pricing implications of different industry momentum strategies. So we follow standard practice and sort US industrial portfolios into quintiles. So we operate with 5 groups. The first group comprises industries that have the lowest returns in the previous months, and the 5th group comprises industries with the highest returns in the previous months. And now we are talking obviously about this short-term momentum strategy where we base our sorts upon the returns or the performance of the previous past months. So the zero cost portfolio is then constructed in a way that is short in the 5th group, so the group that has the highest return in the previous months, and short in the 1st group, so that comprises those portfolios that have the lowest return in the previous months. Using a correlation analysis, this strategy is compared to traditional industry momentum strategies. So where we basically cumulate where we determine the performance using 6 months or 12 months time window. Further analysis examines whether the industry momentum strategies can be explained by the Pharma and French 5-factor model. So motivated by current research, current literature on risk momentum or on risk managed momentum, we explore risk managed industry momentum strategies and the associated tail risks by means of optionality regressions. So optionality regressions we will not cover in this lecture, but we will have a look on the tail risk correlations instead. What we also will not do is we will not discuss stochastic discount factor modeling. Again, using stochastic discount factor models implies that we need to use generalized methods of moments technique, and this is what we will not cover in this course. But what we will do is we will investigate sample split tests. So we employ sample split tests in order to check the robustness of our findings. So we want to explore if our results are sample specific, okay? So our study contributes to the literature in some important ways. So first of all, we explore the correlation between different industry momentum strategies. And the idea basically behind this issue is that in an earlier paper, me and two of my colleagues, we find that industry momentum is uncorrelated with risk factors in Farm and French, of the risk factors in the Farm and French 5-factor model. Moreover, we extend an earlier paper of mine, or two earlier papers of mine, by employing Morera and Moore's risk managing approach to the proposed zero-cost portfolios based on first-order autocorrelation. So unlike earlier studies, we investigate if the zero-cost portfolio based on short-run industry momentum or the risk-managed counterpart are subject to Daniel and Moskowitz optionality effects. Third and finally, we extend Farm and French current study, this 2018 paper, by comparing different industry momentum portfolios for pricing US industry portfolios as opposed to equity portfolios based on firm or other characteristics. In this regard, we employ the methodology as proposed in Sharon, Rook, and Conrad's paper, or in my own paper from 2016, co-authored with Jesper Hager, to identify portfolio-based risk factors in this industrial portfolio setting. So our key finding is that industry portfolios overperforming in the previous months subsequently generate on average significantly higher returns than those underperforming in the previous months. So we find strong evidence for short-term momentum using this US universe of industrial portfolios. Interestingly, the correlations between those proposed industry momentum strategies are low, and this is also supported by principal component analysis. Again, principal component analysis is not something that I will cover in this course. Further analysis reveal that risk managing the zero-cost strategy, in line with Morera and Moore's paper, adds value and substantially increases the Sharpe ratio. Again, we talked about it already in the previous lecture. We are talking about the ex post Sharpe ratio. Yeah? So using these spanning regressions, as in the paper from Morera and Moore, gives us just an idea of the ex post expansion of the mean variance frontier. Okay, this is important to have in mind. Finally, the tail risks of these strategies, we find that they're uncorrelated with traditional industry momentum strategies, which obviously gives some room for risk diversification. And also, these strategies are not subject to any optionality effects as reported or as documented in Daniel and Moskowitz paper. The spreads for a proposed risk-managed short-run industry momentum strategy meets the necessary conditions as derived in this paper from Sharon Roth and Conrad for qualifying as a risk factor. Yeah? So that's basically our paper in a nutshell. This is what we do. This is how we contribute. So of course, always when it's the same thing for if you write a master thesis, somehow you have to highlight what do you do, what others do not do, what do you do better, how do you improve earlier research, how do we improve, what can we do in order to make a strong case here. So the literature review we can skip. That's maybe not so important because we discussed already some of these papers that we refer to here in our literature review. Let us go directly to the methodology instead. Yeah, so we're using as input assets for our portfolio sorts 48 US industrial portfolios. Yeah, we download these data, monthly data, from Kenneth French webpage. We also have to download daily data because which we need for compounding the scaling factor for the volatility managed strategies. So value weighted return data series are employed on a daily and monthly basis. And we also download monthly data for Pharma and French 5-factor model from the same web page. The sample period that we employ is the longest that was possible. So it starts in July 1926, and it goes until February 2018. So the portfolio sorts, so we compound returns from months t-1 until t, and then hold each portfolio in the out-of-sample period 1 month ahead. So we only consider strategies that have holding periods of 1 month. This strategy is referred to as 101 JLK. So accumulation period, compounding period for the returns, where we assess the performance, is J. It's 1 month. In this case, L is a skipping period, so we skip no months in between, but we hold it K months ahead, which is 1. Industries with the lowest quintile returns in the previous months are allocated to the first portfolio group. Industries with the highest quintile in the previous months are allocated to the 5th portfolio group. Then the zero-cost portfolio is long on group 5 and short on group 1. So we buy the winners and we sell the losers. Moreover, we compound returns from months t-6 until t-1, and again investigate a 1 month holding period. So this strategy is then referred to as 611. Moreover, we investigate a zero-cost portfolio that uses a 1211 strategy. That is implemented in a similar manner. But with that, here we accumulate returns from months t-12 until months t-1, and then again we skip 1 month and keep the portfolio 1 month ahead. The zero-cost portfolios are updated at the beginning of each month, for all of the strategies. And the profit performance for these industry momentum strategies are investigated then during the sample from June 1927 to February 2018. So the summary statistics are given in table 1, denoted as, or which has the description portfolio sorts. Again, as I told you already, we operate with 5 groups. Group 1 are the losers, 20% of the loser industrial portfolios, and here group 5, we have 20% of the winner industrial portfolios. For the 101, for the short-term momentum strategy, we see that the out of sample, so the holding period returns are linearly increasing as we move from the loser group 1, to the winner group. So we see that the loser group generates a return in the holding period of 0.57% per month, whereas the winners generate a return of 1.19% per month. So the return difference of the zero-cost portfolio, winners minus losers, is obviously the difference between 1.19 and 0.57, which is 0.62. So 62 basis points per month. If you want to annualize the return, you have to multiply it with 12, obviously. So the t-statistic of 4.61 indicates the significance on any level. And now remember the multiple testing hurdle that we were talking about earlier of 2.78. So obviously this t-statistic here is even higher than the corresponding t-statistic that accounts for the multiple testing hurdle of 2.78. So highly significant. And the same is true for the other strategies. Obviously, the 611 and 1211 strategies also, they generate the corresponding zero-cost portfolios generates returns of 57 and 57 and 80 basis points per month. T-statistic of 3.52 or 5.21, indicating significance on any level. In panel B, we have the average of the cumulative past returns. And of course, it must be so that the returns are linearly decreasing as we move from the loser group to the winner group. Next, in table 2, we have the descriptive statistics for our 3 strategies here that we investigate. So here we see the sample mean given in monthly monthly returns. We see the median return, maximum return, minimum return. Interestingly, of course, the kurtosis, which gives us the tails of the distribution. We have the excess kurtosis here, obviously. So we see that the kurtosis is 13.31 for the short-term industrial momentum strategy and 29.39 for the 611 strategy and 30.03 for the 1211 strategy. So the 1211 strategy obviously has the highest kurtosis, means the fattest tails. What does that mean? So it means that we have to deal with outliers, yeah. So with extreme observations that are in the tails that have a very low probability but a very high impact on the overall return. You also see the skewness here. Yeah, skewness is negative for all the strategies, but linearly increasing as we move from the short-term momentum to the intermedium momentum. Yeah, so the kurtosis is increasing, and the skewness is also getting larger in economic magnitude. Yeah. So that's an interesting finding, obviously. So none of these strategies appears to be normally distributed. The Sharpe ratio is the highest for the 12-on-1 strategy. Yeah, but so is also the risk, obviously, because the tail risk is the highest here. We see the largest kurtosis. We see the minimum, so is the highest. It's minus 63%. So we have one return in this sample period for 1 month that has a negative minus 63% return. So in 1 month you obviously have the risk, or you face the risk that you would lose 63% of your wealth in just 1 month. Yeah. Moreover, what we see is here the short-term momentum strategy has obviously the lowest minimum return of minus 40, and it has the highest, at the same time, the highest maximum return of 22% per month. Yeah. Whereas the 12-on-1 strategy has the lowest maximum. Yeah. So this casts a little bit doubt on if it's reasonable to invest in this 12-on-1 strategy. Next, we investigate the correlation structure. How are these three different industry momentum strategies correlated with each other? So this is what we see in table 3, denoted as correlation matrix. So what we see is that the correlation between the short-term momentum strategy 101 and the 611 strategy is low. It's only 0.2. And the correlation between the short-term momentum strategy 101 and the 1211 strategy is even lower. It's only 0.14. The correlation is low, but positive, and significantly positive, which we see from the t-statistics. The t-statistics are obviously larger than 1.96, indicating significance on a 5% level. And even, you see here, they are so high that they are significant on any level. The correlation between the 611 and 1211 strategy is much higher. Yeah, it's almost 0.7, and highest significant as well. So t-statistic is almost 30. So the next step of our analysis was then that we would like to risk adjust the short-term momentum strategy. Yeah. So the other strategies, this 12-1-1 strategy, yeah, we have investigated in another paper of mine, yeah, which is co-authored with Joni Ruotsalainen and Janne Eijö in our 2018 paper published in Quantitative Finance. Yeah, so we investigate these two strategies, the 611 and the 12-1-1 strategy, in more detail. Yeah, and this paper obviously is more focused on this short-term momentum strategy. Yeah, so what we do is next, then we follow our earlier research, we risk adjust our short-term momentum strategy, which means, first of all, in the first model, we regress the returns of our zero-cost portfolio of this 101 strategy on the market factor in excess form, yeah, which we have here as the CRISP index. So we see that the CRISP index hardly explains anything from the return spread. Yeah, the R square is 0.02, which is close to 0, obviously. So anyways, the strategy seems to be negatively correlated with the market index. Yeah, the correlation, the beta is minus 0.11, and the T statistic indicates that this exposure, the negative exposure to the market index, is significant on any level. The risk-adjusted return after controlling for the market factor is 68 basis points per month. T statistic is 5.15, implying that we have here that even after controlling for the market factor, we have a risk-adjusted payoff that remains significant on any level, even if we control for market risk. In the second model, we control for the 611 momentum strategy. Yeah, we see even after controlling for that strategy, the intercept term of the regression equation becomes still remains significant. And we see also if you control for all factors here, for the market factor, size factor, value factor, 611 and 1211 strategy, we see the R square is very, very low. So it means that these factors here obviously do not explain much, actually nothing, of the short-term momentum strategy. We see also that after controlling for potential risk exposures to these factors here, the intercept term is still positive. It's 0.56, 56 basis points per month remain unexplained. Yeah, and the T statistic indicates this payoff is significant on any level. And this confirms earlier research for the other industry momentum strategies. So obviously, also this short-term industry momentum strategy cannot be explained by standard risk factors and not even by the traditional industrial momentum strategies. Yeah, the R square is very low. So what we do next is we want to investigate the profitability of risk managing our 101 short-term industry momentum strategy. So we follow, in this sense, earlier literature. Yeah, we compound the we have to compound the realized volatility for the previous months for our short-term momentum strategy. Yeah, which we do here in this formula. Yeah, we take simply the squared daily returns over the we sum up the squared daily returns over the previous months. Yeah, that's our realized volatility estimate of our strategy. So what we do then is obviously, we estimate the realized volatility again using the squared daily returns over the previous months, and divided by the number of trading days. So that's basically what we see in figure 1 is the time evolution or the evolution over time of our realized volatility. As we see, it has typical patterns of volatility clustering. We see periods of high volatility and periods of low volatility as well. So then what we have here in equation 3, we have our standard formula. We have here on the right-hand side this small r101 at time t, given time t, is this plain return of our unscaled standard short-term industrial momentum strategy. We multiply it with the scaling factor here, where we have a target level of volatility, which is a constant, and we set it as 12%. And we divide it by the standard deviation of the realized volatility of that short-term momentum factor of the previous month. Which you see here. So the estimate of that guy, which is in the denominator here, uses basically the squared daily returns over the previous months. So when we see, again, like usual in this research, we see that whenever the factor volatility, of that short-term industry momentum strategy, whenever that is higher than the target level of volatility, then we would decrease. This becomes lower, less than 1, and we would deleverage the amount invested in this portfolio here. Whenever the volatility in the previous months is lower than the target level of volatility, this guy here, the scaling factor, becomes larger than 1, which means we would leverage the position kept in this short-term momentum portfolio. So it's the same thing what we have already discussed in the previous papers. So this is a scaling factor that either leverages or deleverages the position hold in the zero-cost strategy, and this depends on what is the current state, or what was the previous month's realized volatility of that risk factor here. So doing this, we have in table 5 the descriptive statistics for the risk-managed short-term momentum strategy. So we see here unconstrained is we just take this whatever comes out here, we take any leverage, and what we see is here the unconstrained strategy generates average payoff of 1.16% per month, which is obviously huge, and which is much larger than the average payoff of the standard strategy, which you remember is 0.62. So 1.16 is much larger than the standard strategy, which generates a payoff of 0.62 per month. What we also see is the kurtosis here is lower than in the unmanaged, unscaled strategy. So the kurtosis is 9.74, whereas the kurtosis of the standard unscaled strategy, you remember from the previous table, is 13.31. And the skewness becomes positive. It was earlier negative. So obviously, the unconstrained strategy shows that we decrease, or we improve our skewness risk considerably, and we decrease the fat tailness of our return distribution. So next, if we employ a leverage of 1, if we say, okay, we take a maximum leverage of 1, so whenever the scaling factor here of equation 3 would suggest to take a leverage that is larger than 1, we would just take a leverage of 1 anyway. So we employ a cap of 1. So we only take maximum amount is 100%. In this portfolio, in this short-term momentum portfolio. But we deleverage our position whenever the scaling factor is below 1. This is what it means. And in this case, we would have a payoff that is basically very similar to 0.61. So it's 0.64. But we see that the kurtosis decreases dramatically, and the skewness becomes 0. So, and the similar pattern we see if we employ a leverage of 1.5. So we say, okay, we take a maximum leverage of 150%. So when this guy here suggests 1.6, we would invest anyways just 1.5 in this zero-cost strategy. So 150%. 1.5 is 150%. So we have a cap of 1. We take a cap of 1.5. And in this case, so we would generate a slightly lower payoff than in our unconstrained case. So obviously it's difficult to operate with leverage of larger than 150%. So it's difficult to get it done with your broker. So you face usually leverage constraints. So if we have a realistic opinion on that, and we employ a leverage of maximum 150%, which makes sense, then we could basically earn 0.9% per month average payoff. yeah, using a leverage of cut of 1.5 leverage. And we see the same patterns here. Of course, the kurtosis risk dramatically decreases, yeah, from 13.31 to 9.03. It's even lower than in the unconstrained case, obviously. And the skewness becomes positive, yeah, which is very nice, obviously. So what we can see is that obviously the risk managed strategy has some very appealing features compared to the standard unscaled strategy that we have seen, or that we have summarized in table 2. So what we have to do now is what we do next is we perform spanning regressions. So what we have to do is we want to see, okay, how does this portfolio perform after we control for the exposure to the unscaled strategy. Yeah, we have seen this in the earlier paper. We have already discussed this here in detail in the earlier paper. So what we have to do is, what we take now the unconstrained strategy, which is also taken, which is also employed in the other papers as well. And as far as I remember, we do the same thing for the caps here for having a cap on a leverage of 1.0 and 1.5 in the appendix. But anyways, we use first the unconstrained strategy and regress it on the standard strategy, on the unscaled strategy, which we see in table 6. So the R square is very high, 0.75. So 75% of the variation of our risk managed short-term momentum strategy is explained by its standard strategy, yeah, by the unscaled strategy, yeah. So the exposure is 1.25, and the t-statistic indicates significance on any level. Yeah, the t-statistic is 56.78. This is something that you see rarely in financial markets. Yeah. So, but the intercept term, the part that is unexplained by this unscaled strategy, is at least 36 basis points per month, with a t-statistic of larger than 2.78, yeah, or 1.96, much larger. So significant on any level. So again, we can also, instead of controlling just for the unscaled strategy in model 2, we also control at the same time for the size factor, value factor, and the market factor, the CRISP index. And we see that 33 basis points of the excess returns of the risk managed short-term momentum strategy remains unexplained. So what does that mean? It means that using the risk managed strategy in association with the standard strategy leads to an ex post expansion of the mean variance frontier. What we also learn from table 6 is that this risk managed strategy is obviously uncorrelated, at least on a 10% level, uncorrelated to this standard Raman branch size and value factor, which is at this stage not surprising. So what do we do next? Next, we want to investigate the tail risk. We have seen the kurtosis is larger than 3. So whenever the kurtosis is larger than 3, we are not dealing with a normal distribution anymore. Yeah, so we have a tail risks. We have outliers that have an impact, a huge impact on the return distribution. Yeah, so this is what the kurtosis means when the kurtosis exceeds 3. So in table 7, we report the 15 most negative returns sorted by all strategies. So our results indicate that in only 2 of 15 months do the worst negative returns of the short-term momentum strategy coincide with the 611 strategy. Yeah, the lack of tail risk correlation between the short-term momentum strategy and the 611 or 1211 strategies suggests that the tail risk, which basically is the crash risk, in plain industrial momentum strategies can be reduced by simply combining these two strategies, which is an interesting finding, yeah, especially for portfolio management. So this again we can skip. Let's just have a look on table 7, yeah, on the tail risks. So again, what we see here from 1 to 15, we have the worst 15 months of payoffs. And sorted by the 101 strategy. So the worst payoff was obviously in 1933, long time ago, in May. Yeah, we had a payoff of minus 40.75% in this 1 month. Yeah, in this 1 month, the 611 strategy had generated a payoff of minus 14.11, whereas the 1211 strategy generated a positive payoff of 14.05. And here in the last column, we see that the risk-measured counterpart of this 101 strategy, generated a payoff of minus 27.97. So the payoff was not so negative than the unscaled, the plain strategy. So, and here, if we go through the table here, so we see basically what are the corresponding returns of the other strategies when we had the worst negative returns for this short-term momentum strategy. Yeah. In panel B, we see the same thing, but now we sort the most negative returns with respect to the 611 strategy. So this vector here has now the most negative returns. Yeah, and we see the most negative return of the 611 strategy was generated in August 1932 with minus 51.39%. Yeah, this is the way how you read this table here, and what you see is here all 15 payoffs of this 611 strategy were negative, and we see that these our short-term momentum strategy had only 3, 4, 5 on 6 days, on 6 months, in 6 months negative returns. So on 9 out of 15 months, when this 611 strategy generated the worst negative returns, in 9 of these months, this 101 strategy generated positive returns, which is obviously good news. What you see also here is that the tail risk of the 611 strategy is much higher correlated with this 1211 strategy. You see almost all of the payoffs here are negative as well for the 1211 strategy. There are only 2 positive payoffs. And here in panel C, finally, we sort with respect to the worst negative payoffs of the 1211 strategy, which we see in this column here. We see the worst payoff was generated in also in August 1932, the same month when the 611 strategy generated the worst payoff, but the payoff was minus 63%. So it was the absolute worst months that could happen here. And again, we see that when we sort with respect to the 1211 strategy and consider that all payoffs were the worst negative payoffs here, we see that 8 payoffs, roughly 50% of the 101 strategy or short-term momentum strategy have been positive. So we can basically reduce the portfolio risk of this standard industry momentum strategies, this 1211 and 611 strategy, by just adding this short-term momentum factor. This is basically what we learn from this table. Then here finally in panel D, we sort with respect to the risk-managed 101 strategy. And what we see here is the worst months has been obviously in June 1938. And the worst payoff has been minus 28%. So the worst payoff of the risk-managed counterpart is corresponding to minus 28% is obviously not as high as the unscaled, the standard counterpart, which happens to be minus 40.75. So risk managing obviously has the effect that it lowers the worst payoffs generated from the strategy. This is what we learn here from table 7. So the tail risk obviously decreases when we employ the risk-managed strategy instead of the plain strategy. And moreover, we see that the short-term momentum strategy, the tail risk of the short-term momentum strategy is in essence uncorrelated with the other momentum strategies. As I told you already, table 8 we can skip. Table 9 we can skip as well. This is something what we do not cover in this course. If it would be a doctoral course, obviously I would cover this. Let's go to the robustness checks. The question remains of if the payoffs of our 101 or short-term momentum strategy implemented in industrial portfolios are the payoffs sample specific. So here we already wrote that we find that the economic magnitude of the spread does not diminish in the second sample. So what you basically have to do is you have to run a sample split test if you want to show that your results are not driven by a subsample. So what we do is, in this case, we divided the overall sample into 2 subsamples of equal lengths. Yeah, the first subsample period is from June 1927 until December 1972, we report the corresponding point estimates in table 10. Then the second subsample runs from January 1973 until February 2018. So whenever you run a sample split test, you should divide the sample equally. Yeah? You should have the same number of observations in each subsample. If you don't do that, people might wonder why you chose more observations in one of the samples. Yeah, it could be basically people might wonder if you somehow try to manipulate your results. Okay, so the best starting point if you do a sample split test or if you want to show that your results are not depending on a sample is you divide the sample evenly. Yeah, that's the best point of departure. So what we see here is in model A, yeah, we regress the for the first sample our 101 strategy on the CRISP index. And we find obviously CRISP index doesn't explain much. The R square is very, very low. And we see, okay, it's slightly negatively correlated. Yeah, the correlation is significant. Yeah, is -2. The t-statistic is -2.68, so it's significantly negatively correlated with the CRISP index. But we see that 0.73% per month of this strategy remains unexplained. Yeah, and if we move down here from model 2 to model 4, we see that all of the strategies, irrespective of what control variables or what set of regressors we use, yeah, we have still between 0.5 and 0.73% per month remain unexplained by exposures against these risk factors here. An interesting thing is maybe in model 4, what we see is that this short-term momentum strategy is obviously invested in big stocks, in this sample period at least, and in value stocks, because the beta against the size factor is negative. Yeah, and we know that the size factor is on the short side invested in big stocks. Yeah, it's small minus big stocks. Yeah, if the beta estimate is negative, it means it co-varies with the short leg. Yeah? And in the short leg, obviously, it is exposed to big stocks. So it invests in big stocks, and it's significantly exposed to big stocks. Whereas the exposure against the value factor is positive, and we know that on the long leg of the value factor are firms that have a high book-to-market ratio, which are in essence value stocks. Again, the correlation or the exposure is significantly positive. Yeah? So again, in the first subsample, we see that our short-term momentum strategy obviously generates 55 basis points per month excess returns that remain unexplained by exposures against other risk factors. We also know that the strategy is exposed to big stocks and value stocks. In table 10, we see the same thing. Yeah, the excess return that remain unexplained by exposures against other risk factors vary now between 48 basis points per month and 65 basis points per month as we move from model 3 to model 1. Yeah, and again, all of these risk-adjusted payoffs, yeah, are significant on any level. Yeah, what we see by the t-statistic, because the t-statistic is equal or larger than 2.96 for all models. What we also see is, again, if you consider model 4, even for the second sample period, yeah, we see that our short-term momentum strategy is exposed to big stocks, yeah, significantly exposed to big stocks. This is a little bit smaller magnitude as in the first subsample, but still significant on at least a 5% significance level. But we cannot conclude that this short-term momentum strategy is exposed to value stocks because this point estimate against the HML factor is not anymore significant, yeah, and it's moreover negative. But the t-statistic indicate that this point estimate is not different from 0. So it's not exposed anymore to value stocks only. So it's equally much invested in growth stocks. This is what we learned from table 10 and table 7. So the payoffs are very similar and do not appear to be sample specific if we divide the overall sample into 2 subsamples of equal length. But then, obviously, we received a reviewer feedback when we handed in this paper to the journal. We had a reviewer, yeah, and he basically argued that one could argue that the trading costs in the US stocks have declined dramatically, largely due to decimalization in stock price quotes in April 2001. In light of this decrease in transaction costs, it is likely much easier to directly exploit this short-term industrial momentum strategy that requires frequent trading. Yeah. So one could argue, so one would expect a priori that the profitability of the strategy is lower than it was previously. So that was basically the review comment, and we estimated it. Then, of course, we addressed this review comment. So therefore, we also investigated the May 2001 to February 2018 period separately. So given this sample period, the average returns for these strategies are 0.19, 0.09, and 0.34 basis points. So 0.19 obviously for the short-term momentum strategy, then for the 611 strategy, 0.09, and for the 1211 strategy, the payoff was 0.34. Yeah. So the t-statistics for these payoffs here indicate that the strategies obviously did not generate any positive returns over this subsample period. Yeah. So for this latest subsample, yeah, for over the last 20 years, obviously, or at least these 17 years, from May 2001 until February 2018, our none of these industrial momentum strategies generated any excess returns, yeah, which is also an interesting finding. Finally, we have been investigating if the short-term momentum strategy could be a risk factor. Yeah. So the theory behind it is the law of one price, and we employ basically the conditions proposed in Schauenroth and Conrad's paper. Yeah. So what we have been doing is, so we have been running or implementing a Gaussian mean model, yeah, we regressed where we have in the mean equation what you see in equation 8. Yeah, we have on the left-hand side the risk managed, or yeah, we have first of all here we have the unscaled, the standard short-term momentum strategy. We have an intercept term, yeah, in the mean equation, and we have the standard deviation as a regressor given time t+1. Yeah, we have here the time index is time t+1 always, and of course we have a regression intercept term for the mean equation. Then we model then we have also here different models, obviously, for the mean equation, yeah, which you see in equation 9 and 10. But let's just first focus on equation 8, yeah, which is the plain Gaussian mean model, yeah, where we have the volatility in the mean equation. We could also take the variance, which we will see soon. So we need an equation for the variance as well. And the variance equation is given here, yeah, or also in the text. This was in the table. So we see here in equation 12 the equation for the variance, the conditional variance of time for time t+1 is we have an intercept term delta 0 and an exposure against the squared residual from the mean equation, yeah, equation 8. Here, this guy, and there's also the equation for the variance squared, and plus delta 3 times the lagged variance. Yeah, we see here it's time t, because here we are here modeling time t+1. This is lagged. Yeah, it's lagged at time t. So this model can then be estimated. Yeah, and what we are interested in, we have to check if the intercept term of the mean equation is 0, and if the time series evolution of these returns of the short-term industrial momentum return is explained by its conditional variance. So we have to investigate if the gamma is statistically significantly larger than 0, yeah? Because the time series or the sample average of our short-term momentum strategy is positive, this gamma here should be positive as well. If we can show that the payoffs here are fully explained by its conditional variance, yeah, then this would be basically a candidate, or this would qualify to be a risk factor. Yeah? And instead of the standard industrial momentum strategy, we can also use the risk managed counterpart here. So we test both. Yeah? First, we use the plain strategy, and then we check the same using the risk managed strategy. In table 12, we estimate these Gaussian mean models. And why is it denoted Gaussian mean models? Again, because we have the variance term not only in the equation for the variance, but it also is a part of the mean equation. That's why it's Gaussian mean model. So in table 12, we see the estimated Gaussian mean models employing the plain short-term momentum strategy. Yeah, so we have here operating with different models, obviously. Let's just take the first row here. Yeah, we see we have a constant. The alpha, alpha is 0.32, and it's significant. We see that the volatility in the mean equation is statistically not different from 0. So again, if we go to this equation 8, which is important, this guy here is significantly positive, and this guy here, the gamma, is significant. Is not significant from. It's not significantly different from 0. So we can now already say by watching this equation here, by our estimates, that our plane strategy does not qualify to be a risk factor, right? And in the other equations here, once we control for, if we add the market factor to the mean equation here to equation 8, yeah, we add the market factor here, or we add the size and value factor. So it doesn't matter. In each model specification, the intercept term, the alpha, remains statistically significant, whereas the volatility in the mean equation is not different from 0. Panel B, in panel B, we see the corresponding estimates of the variance equation. This is not so, no, sorry, once again. In panel B, we use the volatility in the mean equation, whereas in panel A, we have been using the variance in the mean equation. Okay, so once we use here the volatility, this is in panel B, and in panel A, we use the squared volatility. Yeah, we use the variance here instead. It's a different Gaussian mean model, but it doesn't matter because we have the same. We come to the same conclusion because using the volatility in the mean equation instead of the variance, we have the same results. Yeah, so neither the variance nor the volatility in the mean equation is significantly different from 0. Yeah, but using the only difference is that when using the volatility in the mean equation, we see that the average payoff also becomes not different from 0. So on the right hand side, we see the corresponding estimates for the Garch and arch term. The arch term is in the volatility equation, in equation 12, this residual term squared, that's the arch term, and the corresponding point estimate is this delta 1 here, and the Garch term in the mean equation, it's the corresponding point estimate delta 3 here. Yeah, and the intercept term is obviously this delta 0. These are the point estimates that we see here for the arch term, the delta 1, and the delta 3 for the Garch term, and the delta 0 for the constant term. And of course, what we see here is that the for the variance equation, all parameters are significant, which is not surprising, and which is also not so important here. Another thing, the only thing that might be interesting is if you add up the parameters for the arch and the Garch, yeah, for instance, here for the first equation, 0.51 plus 0.15 is 0.66. Yeah, so it's smaller than 1, and it's for each of these models here, it's always smaller than 1, and this is an important condition because if you add these arch and Garch parameters, yeah, this delta 1 and delta 3, it must be smaller than 1. Otherwise, the Garch process is unstable. Yeah? So this is an important to know or to have in mind when operating with Garch models or Gaussian mean models, irrespective of which Garch model you operate with. The sum of the arch and Garch parameter both should be positive, obviously, and they should be smaller than 1. They should not sum up to 1. If we now move to the next table, table 13. In table 13, we report the Gaussian mean model estimates using the risk-managed short-term momentum strategy. Yeah, we see here on the again on the left-hand side the mean equation, and on the right-hand side we see the estimates for the variance equation. So if you check the equation for the variance, again we see that everything is here in order. All point estimates are highly significant. What we see here from the mean equation, we see that the constant, the alpha in the mean equation, if we just use check now the first model where we have no control variables, yeah, it's this plane equation 8 here, where we don't have any control variables, the alpha again should be, if our risk managed short-term momentum strategy would be a candidate for a risk factor, we would see that this alpha is statistically not different from 0, and the gamma should be larger than 0. It should be positive, right? Because we want to see that this the payoff should be fully explained by its conditional variance or conditional volatility. So again, let's go back to table 13. So what we see is the alpha using this plane model suggests that it's not statistically different from 0. This is actually also what we want to see. What we also learn is that the exposure against the variance in the mean equation is positive, and it's significant on a 5% level. So from this model here, we see that obviously our risk management strategy qualifies for being a risk factor. If we add the market factor in the mean equation, in equation 8, then we see our results remain unchanged. Again, still, the constant, the alpha, is statistically not different from 0 because the t-statistic is minus 1.18, and the volatility and the exposure against the variance in the mean equation is positive and significant. Same is for the last model here. What we see in the last row, even after controlling for the size and value factor in the mean equation, we see that the constant, the alpha, is not different from 0, whereas the variance remains significantly positive in the mean equation. So seeing these models here, we can conclude that the risk managed strategy obviously qualifies for being a risk factor. In panel B, we use in the variance equation, equation 8. Let's go back to equation 8. Now here we use this model here. We use the volatility, in the mean equation. So, and we see the same thing basically. So we see that the alpha, even though you see one star here, it's not significant on a 5% level. It's larger than minus 1.96. So it's on a 5% level. The alpha is statistically not different from 0, whereas the gamma, so the exposure against the volatility in the mean equation, is highly significant. It's 0.69, and the t-statistic is 2.18. And if we go now through the other model specifications here, irrespective what control variables we use in the mean equation, we always see the same patterns. We see that on a 5% level, the alpha remains statistically insignificant, and the exposure against the volatility in the mean equation is positive and significant, thus qualifying for a risk factor. So to conclude, so we investigated asset pricing implications of first order autocorrelation in momentum strategies based on US industrial portfolios. So we investigated short-term momentum using the past month's performance for sorting our momentum strategies. So we applied a portfolio approach, which is common practice in asset pricing research. Our findings indicate that first-order autocorrelation plays an important role in spanning the cross-section of US industry returns. We used quintile sorts, and the spread between industries with the highest previous month's returns and those with the lowest previous month's returns, which we dubbed as 101 strategy, is economically large and statistically significant at any level. So our results, of course, challenge the efficient market hypothesis that posits that all information is reflected in current asset prices. We also find that the correlations between the short-term momentum strategy implemented in industrial portfolios and those of the 611 and 1211 strategies are low, and that controlling for traditional industry momentum does not diminish the significance of the 1-0-1 strategy. Yeah, we have seen this in the regressions for risk adjustments. Moreover, risk managing the short-term industry momentum strategy boosts its Sharpe ratio. Yeah, and we have also seen that the risk managed spread or short-term momentum strategy meets the necessary conditions for qualifying as a risk factor. Yeah, thank you for your attention. What we will do next is we will go through a data set and implement some of the analysis in eViews.